Morning, everyone. Thanks for joining the Market Chameleon pre-market webinar. Before we get started, please take a look at the share disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning Market Chameleon tools and products. With that, good Tuesday morning, Dimitri.
Good morning, Will. How are you?
Good.
Good morning, everyone. Let me share my screen here. And I think today what we'll do is cover how to find a trade ID in SPY, and we'll look at a option straddle. We did a couple of different strategies in this last week. Let's look at a straddle today. So the idea here is if you come to SPY, you just type in SPY in the search, and you land on the SPY main page. It'll look like this. And then on the left-hand side, you have menu items to select from under options. If you find trade ideas and you click on it, you'll come to a page which produces these trade idea cards. And I'm going to just close my menu bar to expand this. And these cards are looking at different option strategies that we have screeners available to you. And these particular trade ideas are filtered from our preset filters that that we have out of the box. So if it meets these conditions, it'll produce a trade idea card in different strategies. So here it kind of shows you just the top three selected by theoretical edge. But if you drop this, if you click on that selection item, you could see that there are different types of strategies you could select from. So let me close this, and out of these three, you could see there's a long call, long straddle, debit iron condor. Let's cover the long straddle today. And the straddle, it's an option strategy, or if you're buying a call, buying a put, right? You're getting long that straddle. The idea there is that the stock has to move by a big enough percentage to cover the cost of both the call and the put in either direction. So you're looking at a straddle price that is potentially undervalued, underpriced relative to the expected move. And so you have to have an outlook that the stock is going to, have a significant move, or at least enough of a move to cover the cost of that straddle to be profitable. So let's review this straddle, okay? And then we'll take a look at the analysis of it, and why it appears here. And of course, you still keep in mind any option strategy, you have to have a certain outlook that fits this particular strategy. So in this situation, it's looking over here. These are the legs down here. It's looking at the December 17th, 607 straddle. So you're buying 607 call, buying the 607 December 17th put. That's the straddle. And let's see, the stop was around, it was 606.79. That's where it closed. So it looked at the straddle and it analyzed it from what the displayed market is on the ask side. This is what it would cost to buy it on the offers. So that's what it's analyzing. But keep in mind, the markets have a bid and an offer, bid price and ask price. And as a trader, you could always try to get a better execution and try to buy it, below the ask, midpoint, whatever, that's your job as a trader. But as a starting point, it analyzes it from the price that is displayed, that you could get an immediate execution on the ask. So that is this price, $2.09. So then it goes into the database and says, well, let's first evaluate that price. How does that market price measure up to some benchmark that we could create? And is this above or below the benchmark? Okay. Is this a potential opportunity from that perspective? So it goes into the history and says, okay, well, this straddle has only 1 day left, right? It's expiring December. It's expiring today at the end of the day. This trade idea card, we're not open yet. So this trade idea card was generated yesterday at the end of the day, right before the market closed. This is where the markets were. And it said, okay, let's go back and see what is the average or based on the stock behavior, a 1 day move in SPY, right? Based on a percentage move, the 1 day percentage move in SPY goes back in history, takes those observations and then says, on average, what would this straddle be worth? Right. So that's what it's doing, going back in history and saying, on average, based on 1 day percentage move, what would this straddle in theory be worth? And this is saying $3.05. So that's the average percentage move. Convert that, put it back into the model. Well, what should we pay for the straddle? $3.05. Okay. So that gives us our base model, to start out with. And that, when you compare the two, right, then if you're buying it below, well, that's in theory edge, right? You're buying it below a theoretical value or base model that we created. And we could see, well, how significant is it below? Well, this would implies a 45.8% theoretical edge. So pretty significant discount to that, to the theoretical value. The market price is pricing it very low. In addition, we have another stat on there to help us try to evaluate that. And even though we have this theoretical value, it's an average value, $3.05. That average could get skewed up because a straddle could have a very big move. It could have maybe there's a 10% move out there somewhere, or 15%, who knows, really big move that skewed the entire average higher. So we want to look at then how often, if we use this 209, we could calculate the percent move that it needs. Well, how often did the stock in our observations move enough, by big enough percentage to cover historically the cost of this premium, right? The cost of that straddle. Well, that's saying 53%. So 53% of the observations historically, the stock moved enough, that 1 day move was enough to make this, this premium profitable. Okay. So that's the starting point. That's where the trade idea card comes from. And, that means that if today the stock moves by more than 209 away from, $607, then the straddle will be in the money. It'll be worth more than what you paid for. Okay, so we could see it's kind of already doing that in the morning. So actually, at any point, during the day, it will be in the money. It doesn't have to be at the end of the day. If it does that in the morning, it'll be profitable too. Okay. So if we wanted to go in and analyze it further, we could click on this options chain arrow. Click on that. Takes us to the options chain. And it will go to this December 17th expiration. Okay. Because you could see here, this is yesterday's close. We didn't open yet, so we're analyzing it from yesterday's closing prices. And here it populates the legs for us. So you could see December 17th, 607 call, 95 cents. So this is the 607 call, 95 cents. This is the bid and offer, 94 cents, 95. 607 put, buying for $1.14. Market's 112, 114. So I'm going to run that analysis. Okay, and now we have this 209. That's what it costs us. You can see theoretical value, 375. So it's running a little bit different numbers. Now it's updating to, today. So it's taking the last observation out, putting in a new one. But still a pretty, big theoretical edge, $66. Here, the historical win rate's shown us 60%. Actually, you know what? The inputs, let me see here. Sorry, I was looking for something I thought
No worries.
was in there. So with this, we see a 60% win rate and a probability of touch of 91%. So in the straddle, when we look at the straddle, there's if it's moving around, right? If it's moving around intraday, there's a chance that the stock could move enough to make this particular straddle profitable at any point, even before the end of day, before the expiration. So that's what this probability of touch is, where it touches a point where this straddle will be worth anything above 209. So it's looking at the intraday moves, the high and low, and says at any point, if it became profitable intraday, it would be considered a win. So at some point, this would have covered the cost of that straddle, and if we use those probabilities, that's shown at 91%. So it's if we used all the data, not just the end of day to end of day, but if we used end of day, intraday, high, low, and end of day data, if we used all those, then you could see that it actually has a pretty high chance of hitting it at any point. Okay. So that was a 91% probability touch. Now, for so that's using the historical stock moves, right? That's looking at just how the stock behaved historically. What about how the options typically get priced with 1 day to go, right? So if we looked at the straddle and we looked at the implied volatility of the straddle historically, with options that have 1 day to go, and we took those implied volatilities we looked at the historical implied volatilities and we plugged them into the Black-Scholes, what would be the average price? So the average price here was 369. So again, that shows between 209 and 369, $1.60 theoretical edge, meaning that the options were priced below where they're priced on average. Typically, if we use the historical implied volatilities for similar options, you can see there's a big difference between the market prices and average. So that's using the average, but of course, we were talking about that the average could get skewed higher because there was like some crazy day with implied volatilities really high. So to check that, we could take all our data, historical data, and sort it from highest to lowest, right? Highest to lowest, and look right in the middle and say, well, if we looked right in the middle, that's the median, right? Half of the observations were above, half of the observations were below. What is the median price? 50th percentile. That will give this the value $3.42. So you could see that still it's way below that median. So it looks like very priced on the low end. In addition, we could just compare it to the high and low, right? That's the median price. Well, what is the lowest implied volatility and the highest implied volatility in our observations? Give me a theoretical value and let's see where we stand. So we're comparing 209, the historical low is $1.72, the high 1063, meaning if we use the lowest implied volatility observation and the highest implied volatility observation, plugged in the Black-Scholes model, this is the range. So you can see we're on the low end of that range. And in theory, just looking at these numbers, we could see that if we did maintain, and let me close this for a second. If we did maintain or had an outlook that I think, today we're going to see some volatility. We're going to see some movement. At least what it does on average or higher. Well, then this straddle appears to be on the low end of the range, meaning that if you have the less you pay for it, the less risk you have, right? The more you pay for it, the more risk you have. The less you pay for it, the more potential return you have, right? Because the cheaper you buy it, and if it moves a lot, well, then you make even more, right? So that's what it's looking at. What is our potential risk? Well, it's 209, right? Potential reward, it could be whatever. And based on history, it looks like it's already priced on the lower end of its range. Okay, so that's the straddle trade idea card, how it was generated. If we come lower, we could keep evaluating it. We could look at it and look at it from the liquidity, the bid and the offer. So we could see that it was bid 206, offer 209. So it's 3 cents wide between the bid and the offer, which it's not very wide. It's relatively narrow spread. But there's some room for potential price improvement. Maybe you could buy it at 208. Maybe there's a market maker or somebody out there that if you place the order in between the markets, you might get a better execution. Right? So a little bit of room. So anytime you buy it lower, right? Well, that's less risk, right? Than if you paid more and potentially more reward if it goes in your favor. So that's the bid-ask spread. This shows us the sensitivity of this strategy relative to the strategies Greeks, delta, gamma, vega, theta, rho. Let's move down here. This graph here shows us how this particular straddle performed on the day. Okay. And to track the value of that straddle, it looks at periodic snapshots of the bids and offers, because a straddle value could change throughout the day, even with no trading, because the option markets are continuously updating throughout the day. Market makers stream quotes, cancel, replace. So you always have this bid and offer out there. And that can change based on many factors, including how the stock price moves, the decay, the implied volatility. So the bids and offers are continuously changing, even when there's it doesn't have to have trading activity, right? Because it's a derivative. So what we do is track the markets. Then when we track the markets, well, there's a bid in the straddle, there's an offer in the straddle, and the idea is that the straddle's price or actual value is somewhere between the bid and offer. You know, it could be as low as the bid, as high as the offer, something in between. And to market, we look at the midpoint. Say, okay, let's just call the midpoint right in the middle a market fair value. So the midpoint is in the yellow. Okay, the bid, that's the dotted burgundy line, and the ask is this dotted blue line. And from just looking at the straddle, we could see that the straddle basically lost value throughout the day, maybe because of the decay. And here we could see that the highest the straddle that we capture was $2.61. The low was $2.08. The median price throughout the day was $2.33. Average price $2.34. The very first observation was $2.60. The last one was $2.08. So it lost mark to market 52 cents on the day. But that's what the graph is showing us, so you could see it. And it could be multiple factors in there, you know, decay and so forth. What about the bid-ask spread? So the bid-ask spread can also change. It could narrow, widen. Like, how did it look throughout the day? Right? Because we want to track the liquidity. You know, if we had to, you know, get immediate executions in now, like what does that look like? So here, this is the bid-ask spread, the difference between the NBBO bid, NBBO offer, and the spread. So the highest was 21 cents. The lowest was 2 cents. The median is 3 cents. Average is 3 cents. It started out 7 cents wide, ended 3 cents wide. So typically, it looks like the difference between the bid and ask is 3 cents, which is pretty liquid. That means the markets themselves are relatively narrow. You know, the difference between where you could sell it and buy it. In addition, we might want to know, did this actual strategy trade, like as a straddle? You know, like maybe there's lots of trades in the calls, lots of trades in the puts, but did anybody actually enter an order that got executed that was simultaneous call and a put, a straddle? And we detected that there were 23 trades that were multi-leg trades that appeared to be this particular straddle. The total volume was 98 contracts. So keep in mind, a trade could be 1 contract, a trade could be 2 contracts, or a trade could be 1,000 contracts. So 23 trades for a total volume of 98 contracts, which isn't a lot. You know, in SPY, that's not a lot. What was the average price? The VWAP price, that's $2.17. And when it traded at 217, you know, the VWAP of the bid and offer is 215, 218. So it looks like, you know, that maybe there were orders coming in on the bid side and got a slight price improvement. So this just gives us an idea potentially how the order flow in this straddle was coming in, and that it was closer to the ask price, but there was room. Looks like that there were some price improvement. And the stock reference price, VWAP 606.82. Lastly, this is what the straddle payout looks like at expiration. So you could see here in the red, that's where you lose, in the green, that's where you make. That's where the straddle has to move up or down. So if this current stock price is 606.72, the price has to go, your break even is 609, to the upside 609.09, to the downside 604.91. Anything below that or above that, you're in the money making, you know, covering the cost of that straddle. So to the downside, it has to move a little bit less than to the upside because it's already below the strike. The amount you have at risk is $2.09. Your max loss is right at, if the stock's at 607. So with the stock's at 607, right at the strike, there, that's your max loss, which is right there. You know, you're right near the max loss, and the premium over parity is 0.3%. Okay, so that's really quickly just an evaluation. Once you get fast at, once you know what all these are, you'll be able to scan with your eyes and quickly make that analysis. So I'm going to stop right there.
Yeah, that was great, Dee. Rob actually mentioned with the Fed meeting coming up, this is something to take into consideration and take a look at and do your analysis. So that's interesting, Rob, as well. We do have the Fed meeting. Is that today or tomorrow? I think it's tomorrow, the Fed meeting.
Probably, let me see. I don't know.
Well, whatever. Rob's on. He'll let us know. Thanks for the input, Rob. Thanks for bringing this, Dee, as always. Everyone have a great trading day. Thanks again, Dee. Bye.
All right. Thanks, everyone. Stay safe out there. Have a great trading day. Hope to see you guys tomorrow.